The Fed kicking off its two-day policy meeting tomorrow, and while a rate cut is not expected, Wall Street will be closely watching the language from Chair Powell on Wednesday. So how should you be positioning around the Fed? Well, joining us now is Ohsung Kwon from Bank of America. Good to have you back.
Thanks for having me.
So you like dividend-paying stocks, but here, trying to think like a lot of investors out there, if we're higher for longer, right, and you can get yield from other places, and equities in general are richly valued, doesn't that kind of work against the dividend payer idea?
So what's really interesting is that if you look at the 100-year history of the S&P 500, 1/3 of total returns came from dividends. But if you only look at the past 10 years, dividends only represent about 15% of total returns, so only half of what we saw over the past 100 years. And that's basically because rates were zero. Even if you collected dividends, what are you going to do with them? You were facing huge reinvestment risk. But when rates are at 5%, cash is king. Investors want dividends today than tomorrow. So I think dividend-yielding stocks are going to do better, especially in a higher-for-longer environment when bonds are not that attractive when rates could potentially go higher. But dividend-yielding stocks that benefit from higher inflation as well, those can potentially do better.
I guess also a big growth story of the past 30 years has been these tech stocks that, until last week, many of which were not paying a dividend. I'm being joking a little there with Alphabet doing what it's doing. But earlier we were talking to Mike Santoli about the consumer and how some pessimism around the consumer has some stocks linked to that underperforming. You seem pretty optimistic still. Is that because you think the consumer could perform better through the year than many others are counting on?
Yeah, I think both the consumer as well as the industrial side of the economy are probably going to do better. When it comes to the consumer, we haven't really seen that much impact from the rate hiking cycle so far. And I think one of the biggest reasons is because A, 90% of mortgages are long-term fixed, but B, because of the wealth effect. The U.S. consumer has 5.5 times nominal GDP worth of net worth, $150 trillion. So you got to look at the whole balance sheet. And those who have a lot of cash on the balance sheet, they're actually generating higher interest income. So for those high net worth individuals, they are actually benefiting from this higher interest environment. So I think the consumer overall is still healthy. And especially if we stay at this full employment environment, then I think the consumer is going to stay healthy.
Particularly the higher end consumer, to your point, especially if we start to see some bifurcation there in a more meaningful way. I want to go back to this notion. I'm looking at your report. AI CapEx means money out of tech, money into non-tech. We're seeing this to a certain extent through earnings season already, that the non-AI application companies, more of the infrastructure companies, do seem to be doing well. Just today, Seema Modi reporting on some of the industrial companies that are really benefiting from the AI infrastructure build out. How do you position yourself as an investor to see those returns, realize those returns above and beyond the mega cap tech names?
Yeah, so there's a very interesting dynamics that we are seeing in the market today. Is the reversal of what we saw between tech and non-tech. Tech companies cut costs last year. They lowered their capex as well, down by about 4% last year. This year, they're increasing capex by about close to 30%. They're done laying off people. Layoffs in tech sector is actually down about 65% year over year. On the other hand, the non-tech sector, they're maintaining their capex this year. Last year, they increased their capex by about 9%. Their layoffs are still very elevated. It's actually up 1%. So it really feels like tech is done cutting costs. They're investing in capex. Non-tech sector is still cutting costs. And they're actually going to be the beneficiaries of AI capex because last time I was here, we talked about how power is now the biggest constraints in building data centers. So these power plays, industrials, materials, commodities, I think they are much better positioned than the tech sector.
So I am going to ask, do you think markets are de-risked here going into the FOMC meeting this week? The fact that we've seen such a dramatic shift in terms of what the market's pricing in terms of rate cuts. I think it's like 30% or 35% before 35 basis points before the end of the year now, maybe not even as soon as summer.
Yeah, I think for this FOMC particular, I think the risk is skewed to the upside for equities because the rates market has priced out 2 full rate cuts since the end of, since the last FOMC meeting. And especially if they start talking about potential taper of QT, which is our house view, then I think that's broadly positive for equities.